Today, we're going to find out what's going to happen with the economy going forward. We're going to find out from maybe one of the most impressive economists in the country right now, Cathie Wood. And we're going to be doing that in a shared experience with Larry Goldberg, who happens to know her personally. He's actually interviewed her in a long form kind of biographical interview, which is fantastic, and hangs out with her from time to time outside of that experience. Hey, Larry, how's it going?
Hey, Randy. Yeah. As you said, Cathie Wood is one of the most impressive economists in the country today. And it really comes from being in the economy, from actually running a very large company, a very, market-leading company in many respects. Certainly in their research, they're peerless. And they have the central thesis that growth is going to be the panacea to all that ails us. It's just great it's really great to share her work with everybody. So I'll share some slides
Well,
that
so maybe we can
yeah.
explain that once a month, usually it's on Employment Friday. Cathie does this analysis of all of the economic impacts or the various things that she loves to watch. She divides them into, I think, 5 categories. Maybe it's 6, I can't remember. But anyway, and then you and I, we meekly, with full humility, attempt
Not much humility, but okay, nonetheless. We
we
say with humility, but we opine as if we're great economists.
right, and we look at what she says, and
Yeah.
sometimes we don't even agree. And today, actually, I think there's going to be a couple of times that I'm not going to agree at all. All right, so
Yeah.
I'll turn it
Yeah.
over to you, Larry, with the beginning of the slideshow.
Well, you see the slides, right?
I do see the slides. It
Right. So
doesn't.
this is taken from her November in the know. So she's looking back at the month of November, or the information we gleaned from the month of November. The bad news is that actually there was not a lot of information to glean from the month of November because there was a government shutdown. And so we did not get the Employment Friday numbers, the numbers on Friday. And so a lot of this is based upon existing information that is gotten from other sources other than the government payroll report.
Yeah, okay.
So we can start with an overall summary of Cathie's thesis. And so if you don't want to watch her 40-minute slide, 40-minute shtick, and you don't want to listen to us for the next 35, 40 minutes, this slide tells it all. So this is the current situation, and this is how she sees the path forward. So in simple terms, the current state is we are in a short-term crisis. We have been in a rolling recession, and she sees that Q1 of 25 and Q2 of 25 were really the bottom. We're just out of Q3 25 where we saw a pickup, and there's going to be a very significant pickup again in Q4. This is the quarter we're in. And then she sees a very healthy recovery in Q1 of 26 and Q2 of 26. Just in time, I will add, for the
Midterms, for the midterm.
midterm,
Yeah, yeah.
for the midterm election. So this is the hopeful case for the Republican Party, I guess.
Yeah, and the uh, what do you call it? Yeah, the GDP now from the Fed in Atlanta is saying that the third quarter was at 3.9. I asked Grok to analyze that as to how good is the Atlanta Fed at predicting, and the Grok came back and said it's almost never off more than zero point 0.5. So we could be looking, maybe it's only 3.4, but even a 3.4 for the third quarter would be terrific.
Or it could be 4.4
It could be 4.4. Yes.
or 4.3, actually. So clearly Q1 of 25 is a recovery quarter. We see it all around us. We see it in the market, in the movement in the stock market. And Q4 25, Cathie is telling us, is going to be much better. So markets were nervous due to liquidity drying up, TGA. So we're going to talk about the TGA, the government actual purchases and assets, and the Fed balance sheet down to 6.6. So the Fed is dragging down their balance sheet to sucking money from the market. So we'll soon see, in the next few slides, we'll see how that's going to reverse itself. And the Fed is just missing. The Fed is, still not freeing up the money supply as opposed to actually buying up the debt. But deflationary signals are mounting. Commodity index is the same as it was in the early 80s and 90s.
Yeah. Yeah.
And so metals and gold are beginning to fall now. So the Fed is missing the signals right now, which is normal. I mean, the Fed, it just seems that the Fed gets very, at the end of these recessionary periods, the Fed becomes very, very, skittish. And this is a particularly skittish Fed chairman.
I think if they had 421 PhD economists instead of 420, they'd probably do a much better job.
Right. So the game changer is OB3. This is what Cathie believes. She thinks that the revolutionary tax policy, which brings the effective corporate rate down to 10%, is going to have a huge impact on the economy. And we'll touch on that in much greater detail. But that's how Cathie sees the economy. And I think it's a relatively good call across the board. What do you think, Randy?
Yeah, I think so. And I think that it was interesting that she left out one, and it was part of a conversation yesterday with Treasury Secretary Bessent, which he had with the New York Times reporter, you'll probably, Sorkin. I don't know if you saw that video, but in that video,
at the New York Times conference, right?
Right. And Sorkin goes, hey, Trump says there's $21 trillion worth of investment coming into the United States from these various foreign countries. And we went on the website, the government website, and it says there's only 7 trillion coming. And Bessent says, that's a big number. Yes, the 21 trillion will come, but 7 trillion is a massive number. So I think you add that to the big, beautiful bill. That's really massive.
Yeah. Bottom line is, Cathie says the bull market is firmly in place and will continue apace. And certainly the bull market, which showed a little bit of nervousness a week or so ago, is back on track. It's going to reach Tom Lee's numbers, although Bitcoin is not.
Right.
And nor is any of the other coins at all. And so I think I would say that, we're on the right path. I think you and I have agreed in prior analysis that, we're on the right path. We're getting towards a recovery. There's a short-term liquidity crisis. We definitely felt that a week or two ago. The VIX shot up, stocks went down, Tesla went down. But Cathie says this too shall pass. And the resolution timeline, Fed ends this QT, this quantitative tightening, where they're reducing their balance sheet. They're finally getting back to quote normal unquote levels of assets by year end 25. With the government reopening and TGA normalizes, so that would be the assets held by the Federal Reserve. They reduced back to $600 billion from currently at 800 and something, $900 billion. So that's a big reduction, and this is kind of considered normal. Of course, the Fed has been pumping liquidity, withdrawing liquidity from the markets consistently over this period of time. I don't see the markets being illiquid, even with the Fed action right now. So
Yeah,
if
well, we saw two examples, Larry, when the VIX did jump the other day,
yeah,
and they're really not related, very much, I don't think, to what Treasury or the Fed is doing. But we had the Japanese carry trade, which hit us again, and that was a liquidity issue. And then we did have it in the Bitcoin space. And obviously, if the Bitcoin goes from 120,
125,
125 all the way down to
90,
93,
89, actually, 88.
yes, 89. If 84, and if it was almost down, yeah, it
Yeah,
was
well,
84.
down in the 80s. Yeah,
Yeah, in the 80s. If that happens, well, that pulls a lot of liquidity out of the market as people are covering their margin calls and
exactly.
whatnot. Yeah, yeah,
Exactly.
yeah.
Yeah. So Cathie said this too will pass. I think the actual quotation is this too shall pass. Market's extremely nervous now, but these are temporary technical issues. And I think that, a nervous market is a good market.
Yeah.
Markets that just constantly go up and up and up, that's frightening.
Well, you know what Tom Lee calls this, right? He calls this the most hated bull market in history because when he talks to the clients and when they do surveys of the clients and whatnot, they're all like, "Oh, it's over tomorrow," and they're all worried. And so the climbing the wall of worry has always
Yeah.
been the best. Yeah.
Yeah, the best markets. It's when the market stops worrying. I remember in 2007, just up and up and up, and the expectations was just up and up and up. Boy, that came crashing down.
Yeah, right.
Fed policy disconnect, missing the deflationary signals. They think inflation is not unwinding. That's the Fed's concern. They say that, they think the inflation indicators remain sticky despite rate cuts. There are more hawks, in this Fed than we've had for some years, actually. And I think that's very unfortunate. And the Fed is, despite its easing, the policy remains restricted by some measures, and particularly when it's soaking up debt. Selling out that debt, it definitely is very restrictive. So Cathie said, I don't like what we're hearing from the Fed because I do think they are missing some deflationary signals out there. And here's the evidence. Look at the commodity index. Well, it went crazy in 2008, then it came right down. And by 2015, we had index level at 120. Well, we're even below that 2015 level,
Right. Right.
And this is just this reaction to this crazy pandemic situation.
Mhm.
But really, we want to get down to that 100 mark and stay down there. You know, I think we're at a really good level. I think commodities at this level is very positive, bullish. And if they remain at this level, it could be very bullish for us.
So, Larry, you know that I was a big fan of Truflation a year ago, and then I kind of had a falling out because of their monthly adjustments. And these monthly adjustments were so large, I just couldn't trust it. But slowly but surely, they still do the monthly adjustments, but the monthly adjustments are much more livable.
Measured,
Yeah, yeah,
much more measured, yeah.
much more measured. And so I'm back. And so for people that watch my morning show on Monday through Friday, every single morning, I give the Truflation numbers. And quite frankly, Truflation shows inflation to be under 2.5 at this point. And that's even counting probably zero point 0.4 to zero point 0.5 of that is tariffs. So, which is a price, not inflation, as Besant also went to great lengths to prove yesterday on that same show.
But look at the numbers on that in that regard. China's exports to the US have dropped 25%.
Wow.
China's exports to the rest of the world have gone up 3%.
Mm.
So they're exporting deflation at this point.
Mhm.
So the OB3 revolution, this is third month in a row that we've seen the slide. And it's such an important slide. As I speak often in our shows in Monday and Friday, I speak about this situation. But this is showing that the new depreciation schedule, which Cathie talks about, as I say, every month now, ever since OBB, O3B, we are allowing depreciation on manufactured structures at 100%, whereas it used to be over 30 years, 100% in 1 year, in the first year. It used to be straight line over 30 years, and it's effective in 2000 until 2028, and it's like 5.6% of total capex. So we're talking about a massive,
Right.
a massive a subsidy to companies to build new manufacturing structures.
Right.
Equipment is getting, a depreciation of, straightforward 100%, whereas it used to be 6%, 60%, and that has become permanent. And that's like 36 odd percent, 38%
Of
of,
cap-
all capex. Domestic R&D is now fully expensed. By the way, Tesla fully expenses it on their accounts. It's not going to hit their financials at all. But normally you have to do like a 5-year amortization. This has become permanent. This is the best part of this legislation, because over the long term, it's going to dramatically increase the effectiveness of our R&D. And this is 20% of capex.
Mhm.
And software, we're now allowed to write off 100% of software, whereas we only used to allow 60% of software, and that's permanent as well, and that's 17.5. So, there's a gigantic reduction in taxation now due to this new depreciation schedule. I mean, for our listeners, the explanation is simple. If you can write off your R&D sooner, that just simply reduces your tax rate.
Right. And this gives us a tax. Cathie talks about an effective tax rate, I believe, of 12%.
That's right. We have that on a slide coming up.
Oh, we do. Okay.
Our effective corporate tax rate is now the lowest in the world, in the industrial, in the first world, the
Right.
lowest, and it may be one of the lowest in the world, period.
Right. And so somebody that's sitting at home right now might be thinking about, how do I save a little bit on taxes? Well, guess what? The CEOs and CFOs of corporations, I don't care how big they are, they can be a mom and pop down the street. The CEOs and CFOs of corporations are always looking for ways to save taxes too. And if the way to save taxes is to put it in capex instead of expenses, that's way better. That's way better for the future of the company.
That's right. That's right. So it's really important. It's really important. And, it speaks to this administration's focus on reindustrializing the United States, and it's working.
Yeah.
So OB3 revolution, the impact. So the effective corporate tax rate is now going from 22% down to 10%.
Oh, 10%.
Exactly the point you made.
Mhm.
Prior to this, the effective tax rate of the lowest industrialized country in the world, the first world country, was Ireland.
Mhm.
Singapore, even we're half of, not half, we're about 60% of Singapore's rate, which is 17%. And the OECD average, the average for the top 10 industrialized countries, is like 23, 24%. So this is very positive. At 10%, US becomes more attractive than Ireland. So we're seeing a massive inflow of money. You talked about the 7 trillion rather than the whatever trillion that President Trump talks about from day to day. But the 7 trillion is a lot of money, as you pointed out. There's going to be some big tax refunds in this coming year. And, in about the April timeframe, we're going to see this pour into the economy. Very pro-growth, very pro-business, stimulates investment, innovation, and expansion.
Yeah,
This will
I'm sorry.
This will drive the rolling recession to transform into a rolling recovery and ultimately a productivity-driven boon in 2026. Cathie Wood.
Yeah, so we saw lots and lots of countries moving their activity to Ireland. Ireland is a very small country. And because they had the lowest tax rate in the world, we had corporate headquarters opening like crazy in Ireland and trying to move their money through Ireland so they would be paying that tax rate. Well, now you're doing the same thing, only you're doing it with the most important market in the world. And so people like Apple that moved to Ireland, people like Budweiser who think of a more American company. You know, it was bought out by somebody, I forget who it is, over in Europe, and similarly, Chrysler, you know, ended up being purchased by Stellantis. So you end up with all of those potential people like that. The potential is coming back this way.
And, you know, it should be said that the people that moved to Ireland moved headquarters to Ireland and said, okay, we're now based in Ireland. So Apple had 15 people at one point in
Right.
Ireland
Right.
handling, you know, $300 billion.
Right.
I mean, it was a Swiss. I'm exaggerating. There was probably more people than that and maybe more money than that. But it was just it was a ruse,
Yes. Yes.
just a tax saving ruse. This is no ruse. This is you build it here,
Yeah.
we'll give you the break.
Right. Right.
And so people are building it here. You know, somebody said, oh, the White House is talking about $20 trillion and it's only $7 trillion, as you pointed out. Scott Bessent said, well, $7 trillion is a lot of money. And so the money is flowing in. Foreign investors are very bright. They know what's coming. And so Cathie is right. We're going to see a massive boom, and a boom in, you know, where it counts, in silicon chips, in AI, data centers and AI, you know, development. And we're going to see Tesla manufacturing robots, but not just Tesla. There are half a dozen really credible startups
Yep.
in the robotics space in this country. And so we're going to see a big turnaround, a massive turnaround, and it's very, very exciting. So Cathie talks about the budget deficit and the problems of the budget deficit. It's down from 8% during COVID to 5.7% of GDP. It's still much too high. And she talks about the drivers, the deficit reduction drivers. The one is DOGE. It's having an ongoing effect. The government shut down with the reduction in force, the RIFs, 150,000 federal workers, broader reduction in force underway in government. I'm hoping we see local governments, which, by the way, employ 10 times as many people as the federal government. I'm hoping we see local government follow suit.
Yeah.
I'm not
Confident.
optimistic about it, but I'm hoping for it.
So
And then
I'm sorry.
she talks about SNAP participation. So SNAP is family food stamps and, you know, all that kind of stuff. And we see that the participation rate as a percentage of the population, which rose to an all-time high in, you know, after the global global financial crisis, rose again, you know, in 2021 and 22 during the pandemic, but it hasn't come down since the pandemic. It still remains very, very high, even though the poverty rate has come down sharply since the pandemic.
Right.
And
Yeah.
so the percentage, yeah, go ahead.
Yeah, I was just going to say that a lot of people made a big deal out of the last government deficit numbers that came out, I think, a week ago.
Yeah.
As having been, oh, no, we're not seeing any benefit out of any of this stuff. The numbers are just as high as they've always been. Well, there was a huge amount of revenue that wasn't in that number because of the government shutdown. So we have to wait until the next set of numbers come out before we really see whether the new budget, which starts, of course, in October, whether the new budget is showing any continuing decline in the deficit.
Right, right. But, you know, the labor market continues to deteriorate. Employment weakness indicators, it's the employment productivity paradox. When productivity rises, the first thing that happens is employment starts to fall. Ultimately, employment will pick up again, but that's what happens with the employment productivity paradox. So unemployment duration has gone up to 25 weeks from 20 weeks in 2023. recent grad unemployment has risen to 6.5%, rising sharply. Well, that may be partly the economy, but it's also partly the quality of the grads and the type of programs they're graduating from. There are so many of these, these non-professional jobs, I call them. Think about, I shouldn't say art majors because my son is an art major, so is my wife. But I mean, the truth is we see an awful lot of anthropologists coming into the market now. What an anthropologist can do in this marketplace is unclear to me.
Yeah. Teach.
That's a huge
Teach
problem.
anthropology. Yeah.
Yeah. Federal layoffs are contributing to it, and job openings, though, are declining because of the post-GPT drop. So AI is having the first order effect, which is providing, a reduction in employing new people due to the productivity that AI brings along. Ultimately, that will create new industries. Ultimately, it will employ people. But there's always friction at the interface of new technology, and we're seeing that friction in a real sense. We see the job opening decline from 2022 Q4 down to 2025, and it's very, very considerable.
But that, I mean, you can't really use that. That was just a crazy time. I think it's better to take a look at that chart and go back before the pandemic and see where it was. So the job openings are still above the norm. And
Well,
so
if you look at 2021, which is before the pandemic hit, there was an enormous number of job openings.
we were sitting at 3.4% unemployment. We were already seeing, and before the pandemic, we were seeing huge job shortages. People were putting signs in their window that they were willing to pay
Correct.
$20,000 bonuses for people.
We were in a boom. I mean, let's face it.
Yeah.
Those first two Trump years were, we moved from a slow economy into a boom time, real boom times, and then the pandemic cut that short and led to terrible, problems in the economy.
Right. And then,
sorry.
And then I was just going to say the other thing that's left out of these numbers, or at least the discussion of the numbers, is the huge number of people that are being sent back home. So the outmigration is at 2.3 million now for this year alone. That impacts the number of jobs. It impacts the number of people. It impacts the phone calls that they make and ask how many people in the house are employed. And Bessent's talking about this. This is a big factor.
What you're saying is that the numbers reflect that, but it doesn't necessarily impact employment.
No, it does impact employment, but it's not, nobody talks about it when they're talking about where we are on employment right now. It's a massive, massive factor. In fact, I think not only Bessent talked about it, I think Chair Powell also talked about it, trying to make people understand how okay, I'm an employer and I need employees, but I don't have anybody that's got those skill sets. And so I can't hire those people. There's nobody to hire.
Yeah.
And so and then those people, you can argue whichever way you want to argue, whether these immigrants were adding to or subtracting from the overall economy. But the reality is that they do come in and use goods and services. And to the extent that they use goods and services, that's helping some businesses. So when they go away, when they go back home, there's lots of stories about little restaurants and little coffee shops and things in those neighborhoods that are having to close up because they depended on that trade.
Right. And, AI is replacing, the other factor is AI is replacing entry-level positions. Recent graduates hit harder as AI tools limit growth in entry-level jobs. And AI doesn't have the impediment of having studied anthropology for 4 years. But job search is taking longer. People cannot find jobs. Duration up 25% since 2023.
Yeah.
So here, we're seeing the EPS constantly going up, even though employment's going down, and that talks to the paradox of productivity on employment.
There's a couple of people that are putting forth ideas where we would incentivize people to go to trade school. One person has recommended free trade school. Another person has talked about, a $20,000 maximum payable over 10 years or something. But right now, that's what we need is the trades. We need them big time.
Maybe there should be a rule that anybody who wants to do anthropology at college has to first take a 2-year trade school.
Well, when you go out on the digs, you need to have those skills anyway.
Yeah. Okay. So housing market paralysis continues. I'm pleased to say that I sold my house in the teeth of this terrible market.
And it actually closed.
It closed, and the price was it was very fair price. I was very happy. The buyer was very happy. Everything worked well. But sales are at 1970s levels despite the larger population. So home buying intentions are high, but conditions are terrible. And pending home sales are very low. New home inventory is elevated. So we're back in 1970s levels, even though population has gone up by 30%, 40% since the 1970s. And home price growth is slowing towards zero.
Yes. And you've got that takes months to get
hit
into the CPI.
inflation, the inflation numbers, yeah.
And what you're also seeing, Larry, is that every time that mortgage rate gets down close to 6%, there's a massive spike in home buying and a massive number of additional mortgages taken out. And every time now it's gone back up again to like 6.25. And then people are like, nope, not going to do it now. So you've got this back and forth. If we could get that darn 10-year bond back down in the threes.
Well, here's my prediction.
Yeah.
Sometime in late January, early February, we'll be there with the interest rates.
Okay.
As soon as the Fed ends, it's tightening. As soon as it ends this repurchase of sale of its paper, of its debt paper, I think we'll see the mortgage rate dramatically decline. Good. Because it's competing. I mean, the federal government is competing with the mortgage market.
Got it.
And it's very difficult to compete. So existing home prices are going down, new home prices are going down, and so we need to see reversal to that market.
Let me be a little bit contrarian here. I'm nervous about the housing market. Not that it won't continue to be where it is. I don't see it crashing. I don't see it dramatically dropping, but I don't know how much building we're going to have in the future. Once again, because of all the folks that we've sent home, those folks were mostly in apartments, right? They're mostly in rentals, but the rentals are down to under zero. They're actually negative right now in terms of the price of new rentals. Somebody that's in the margin, they're renting now and they're thinking about buying. If they were paying $1,500 a month and now they're going to get their rent for $1,400 a month, but they buy a house, they're going to be at $2,000 a month. A lot of those are going to stay in a rental.
Yeah, I think we will see some pressure on the buying market, but I think there's such pent-up demand in the buying. I don't think it'll have much impact. That's my guess. I don't have the numbers to back me up.
We'll see what happens. I'm not looking for a crash, just for maybe the home builders won't do as good as we're hoping they're going to do.
Here's a really bad number for you, though.
Okay.
Auto loan defaults are matching the global financial crisis period of 2008 to 2009. There's stress on the consumer. Delinquencies are at crisis levels. So the subprime automotive defaults, look at 2009, look at now. Mm-hmm. It's incredible that we're at that same level. Mm-hmm. But look at, all auto loans. We're higher than we were in 2009. And this is at the delinquency rate. This is not an absolute number. So this is actually a very serious number.
Now, Cathie said it didn't worry her. And I don't think she ever said why. And the only
I think I can answer that. I was about to say that part of this is the rate at which new car prices rose in the past 6 years to astronomical levels. And I think those people who got over their skis to buy the car that they were used to driving, you always bought a Honda Accord, you want to buy a Honda Accord. You always bought a Toyota Camry, you want to buy a Toyota Camry. Well, Toyota Camry used to be a very inexpensive small car.
Right.
It's become a sedan of, $40,000.
Right.
$45,000, $50,000 if you want all the trim and give them cracks. So it's no longer a cheap car. And those people who got over their skis buying that car
During the pandemic, when there were shortages.
Absolutely. And, here we are 4 or 5 years after, or 3, 4 years after the pandemic, and those cars are now haunting their buyers who are struggling with jobs and so on and so forth.
Right.
So it's not a good situation. And Cathie didn't talk about that, but the personal savings rate is not rising, and that's what we'd have to see. We'd have to see some savings, but, it's not happening. Uber Lyft is changing the calculus. People experiencing financial stress says, all right, they can take my car. I'll just take an Uber or a Lyft. And that's going to become much, much more prevalent when Robotaxi rolls out at half the price,
Right.
quarter the price, a fifth of the price of an Uber and Lyft.
Right.
And the velocity of money is rolling over. Consumer pain reflected in the declining velocity of money, indicating reduced economic activity and spending. So this expansion of the economy that we are seeing beginning is not going to be consumer-led. It's going to be production-led.
Right.
It's going to be, business-led. It's going to be investment-led.
But there is going to be, Larry, there is going to be that bounce, as you mentioned earlier, February, March, April, because anybody on tips, Social Security, people that earn money, continue to earn money, people with overtime, and people that have home childcare, all 4 of those groups are going to get refunds that are much larger than they're expecting. And to the extent that they estimate their taxes or want to change the numbers that they're using at their jobs, they're going to have ongoing higher income every month from that point forward.
Yeah, I just wonder if they're going to spend that money in a hurry.
Well, or put it or save it. Either one is going to be a positive.
Yeah. Yep. That's true. I mean, it's not a negative.
Right.
It's just, I don't know that it will. I think this expansion is going to be investment led.
Yeah, I agree with you.
Capital spending boom. Here it comes. Look at this.
Yeah.
Look at this.
Yeah.
Wow.
Yeah.
From 22 to 25, just like almost a straight line up.
Yeah.
Up to a level that we haven't seen. Well, we haven't seen it.
Ever.
I mean,
right. Yes.
No, we've seen it before. And I tell you, when we saw it before, it was early mid Reagan's first term. And then again in Clinton's first term.
Uh-huh.
So yeah, led by data centers. Manufacturing is coming right behind it, because once those data centers are up and running, manufacturing is going to reach the level of where those plants are input. Robotics and automation and energy infrastructure. Energy, we need lots of energy and lots of energy.
Right.
So Cathie said we're in the beginning of a big cycle here in the United States. We've burst through this. And so that's, we're going to see this number reach this kind of level here, which is extraordinary, right?
Right. Yep.
So.
And that's going to result in employment.
That is going to result in employment, no question. And here's the thing, we need these workers. We need, we're probably going to need legal immigration of skilled workers.
Right.
And there's a lot of political negativism about that. A lot of the MAGA guys are very opposed to any form of immigration of any. Immigration has earned such a bad name that it's like it's a verboten word. And that's a real problem, because we need immigration in this country.
Yeah.
We're not breeding.
Right. Yes.
The future generations. We need to bring the future generations into this country, and they need to be highly qualified people.
Right.
well-educated, highly qualified people who we've always welcomed into this country and, who've been, great for the country. We've also welcomed, by the way, poor and hungry and starving and politically dispossessed people. But we've always, scrutinized them.
Yeah. A little bit of vetting would be nice.
A little bit of vetting. Although some people who've been vetted didn't turn out to be very nice, as we know. So the signals that the Fed is missing, these deflationary forces that are mounting and driven by, technology, driven by dropping commodity prices, driven by the deflation that China is exporting, driven by metals prices falling, except silver, driven by the strength of the dollar, driven by declining oil prices and money velocity rolling over. There's definitely deflationary forces in the economy. And the Fed is acting as if there's inflationary forces.
Right.
And, the problem is the Fed should be looking ahead, not behind. Because by the time their actions take place, by the time their actions have force in the market, we're way down the road.
Right.
And if they misread the future because of the past, they make the future worse.
And they seem to be the worst at that, Larry, of all the things that they do poorly.
That's the worst.
Forecasting the future seems to be where they mess up the most.
They're really good about accounting for the past. No, but I mean, seriously.
Yeah.
We always look to them for their numbers, right?
Right.
Really good at that. And then, just before we wrap up, market indicators. This is Cathie's, she focuses on this. And this is the S&P to gold ratio. And look at this.
Yeah.
We're reaching the lowest point of the S&P to gold ratio in 5 years. It's not the lowest point I've seen it at ever, but I mean, gold is high, even though the S&P is very high.
And what did Cathie say? She says she thinks gold is at its nadir. It is going to be coming. Is nadir right? Maybe I used that wrong. It is.
No. You're absolutely on target.
Okay.
Absolutely. That's what it means. Yeah.
It's going to be coming down. So she agrees with you and me.
Right. So gold down relative
Right.
to S&P.
Yeah.
I don't say it's coming down a long way. I'm saying it's down relative to S&P.
Right.
So maybe we're at slightly different odds. So Cathie said the current situation is testing. Ratio is under pressure as gold surges and S&P wobbles.
Mm-hmm.
So this is a good time for you to project what the S&P is going to be at this time next year, the end of
next year. I don't see how we don't have another 20% year, Larry.
Wow.
I know we've had 3 in a row. Well, this year maybe 20%. It's going to be close to 20%. Last 2 were over 20%. But I don't see, if we have the kind of GDP that we're talking about next year, 20% might be, a slam dunk. But 20%, what would that give us? 7,000. That'd give us 8,400. Now, I've noticed that Goldman Sachs, I think it was, or it might have been Morgan Stanley, one of those two, I'm always getting them backwards, did a series of projections. Their base case is 8,000 and their bull case is 8,500.
That's a pretty strong forecast. If it is at 20%, I mean, it'll be an all-time high, of course.
Yeah, by a lot.
I mean, we may see a higher period. We may see it, meander during the year.
Yeah, of course.
But that's a pretty bold statement. But of course, you're not advising people to invest because of that.
No.
Not investment advice.
Right.
What will Tesla be at the end of next year?
I've got Tesla at the assuming I have assumptions now. Okay. So assuming that
Notice I yawned the moment you said I've got assumptions.
assuming that Optimus is being sold to third parties by the end of the year, we will be at 1,000.
Good call.
Okay.
I don't time these markets and I don't project. I gave that up some time ago when I realized just how fruitless and how pointless it was. But I can see an argument that if things go well in terms of delivery of Optimus, delivery of the expansion of the robotaxi, and the delivery of the semi,
Hmm.
which I think is important. I mean,
Yeah.
50,000 semis at $400,000 a piece
Yeah.
is $20 billion.
Yeah.
That moves the needle,
Yeah. Absolutely.
particularly if it's profitable. I don't know how profitable it's going to be in the first years. But anyway, the point is that I think it's going to be a good year for Tesla.
Oh yeah.
I think it's the beginning of a good 3 to 5 year cycle.
Yeah.
Very good 3 to 5 year cycle. And I've been projecting that for a while.
And Larry, that's before we even add in, energy and data centers in space. That's just like a whole new.
Data centers in space are more than 3 years away before they contribute to profit.
Okay. Okay. Yeah. So
They're more than
so
3
you're
years
talking about
away.
1 to 3 years. Okay.
Yeah.
Okay.
So the final slide is all about Bitcoin. This is not really my bailiwick.
Or
Um,
mine.
she says that stablecoins are usurping insurance's role, the insurance role that Bitcoin plays, I think is what this means. So, you don't need to go to Bitcoin if you can buy a stable coin.
Hmm.
Um, it's possible that that's true, and that's somewhat, diminishing the role. And they say it's got a 200K to 300K impact on the price per Bitcoin. They say the gold market cap has doubled, and that has increased the value by it. So these are completely offsetting factors. So
Hmm.
their bull price target is 1.5 million. I mean, do you have a coin?
No, yeah,
It-
I have $10 worth. Well, I don't, it might be more than $10 now, but somebody gave me $10 worth. I don't even know where my wallet is. Yeah.
yeah, I think I've got $1,000 of Bitcoin.
$1,000. Okay. Well, that's like $10 for me, Larry.
Well, bottom line is, I know where my Bitcoin is. I moved it to a wallet. I,
Yeah. Yeah.
I'm, I'm on coin. I'm on base actually. My
Okay.
wallet is on base, and I'm a Coinbase client, and I did this in order to have being able to say to people, "Yeah, I'm invested
Yeah.
in
Yeah. Yeah. There you go.
Bitcoin." I just wanted to see how it works.
Yeah.
I
Yeah.
kind of knew the theory of it. I wanted to actually get a sense of the practice of it. Well, that's it. I mean, Cathie remains positive. You know, I I didn't buy that we were in a rolling recession. My firm conviction back 6, 8 months ago was that we were in a recession.
Yeah.
It should have been called a recession. It was a recession. Um, so I just have this little quibble with Cathie, but I am absolutely aligned with her that we're in this recovery period now and that we'll see a productivity boom in 2026 and that the bull market that Cathie believes is firmly in place will continue apace. And
Yeah.
that's Cathie's word for November of
Yeah.
2025.
And I think not the only thing, but a major thing that we've left out of why there will be a boom in 2026 is that while I've just said, I made my contrarian case that housing might not build as many as they're hoping next year because of outmigration, that doesn't mean I don't think that a lot of people are going to buy houses from existing or from new developments. A lot of people are going to buy houses next year. Well, what does that mean? It means durables, durables, durables. So every month, Home Depot says, we're doing fine on screws and bolts, but we're not selling any refrigerators or bathrooms.
Well, I think you're wrong. I think there's going to be a boom in the housing market come spring
New
next year.
housing, new housing,
No,
new
a
building.
boom in the
Oh, no,
housing
no,
market come
no.
spring next year.
Yeah, no, we're agreeing. I think that people will buy existing homes and they will buy new homes. It's just that the builders are not going to build tons more like you would expect in a nice boom.
Well, that cycle takes time.
Yeah.
And the builders always, overbuild,
Yes.
get into trouble. Many of them go out of business, and then there's a cycle upwards. Anyway, there we are. That's the news that's fit to print. As my good friends at the New York Times, by the way, let me commend to you the current episode of the All In podcast, where they talk about this smear campaign that the New York Times tried to levy against David Saxon, which apparently, rebounded against them. But it's interesting because it's an object lesson on what this press has become,
Yes.
because they actually show you how the New York Times dragged this thing out and constantly, bombarded his office with questions, and they answered all the questions. And despite that, the New York Times went ahead and wrote an article where they pulled all the stuff that they had accused him of in the questioning, and that was the driver for the article. They took all that stuff out, but still left
The headline.
the headline. I mean, you have to, you have to actually, you have to have a lot of, what is the word? You have to, you have to actually,
Brass. A lot
no,
of
I
brass.
mean, I mean, for them to have this kind of power and this kind of ability to create, from imagination, all the bad things that they think about, all the people they think are bad, with such impunity, you have to be so impressed by it, because, my God, the power that they've accrued to themselves.
Yeah.
And they're absolutely invincible. They can't be brought down. They can't be attacked. They're completely, invincible. Amazing.
Except that in that same video yesterday with Besant and at the New York Times uh, program that they put together, Besant says, "I don't." Right there, right to the guy's face. He says, I don't get the Times money. I don't read it."
I mean, they're talking to an audience that are true believers.
Right,
Whatever they print is believed, and it becomes, the facts in their
right,
eyes.
right.
I mean, it happens on the other side as well, by the way,
Absolutely.
from the press. And, it happens as well, whether you're on X or on any of the other
Sure.
platforms.
Right,
You're in an echo chamber and people give you these facts
right, right.
as if they're facts.
Yes, yeah, indeed. Larry, as always, thank you for coming and helping us all get a much greater understanding of what Cathie was. Now I say that half in jest. Go watch the original if you,
Yeah,
because
there's a lot more
Cath-
value, I
Cathie,
think, that,
Cathie does go through it pretty rapidly. So one
yeah.
of the things we are actually, when we first started it, the idea was to kind of unpack it and bring it down to non-economics kind of talk. And I think that we still do that. I think that's part of what we're trying to do. But I think we've kind of slid into kind of a, oh, well, now we kind of get what Cathie's talking about. Now we can disagree with her. So,
Well, I think everybody, is entitled to their opinion.
right.
These are ours, and people can, but I hope we've given them an appetite for hearing from the Oracle herself.
Yes, I don't know why I never tell people they should follow you on X. I mean, what the heck? If you're not following Larry Goldberg, you're making a really, really big mistake. Larry, thanks again, as always. And to all of you out there, it's been great talking to you.